Hello, all. Welcome to today's session in respect of income tax saving and income declaration. My name is C.A. Shoikotroy, and I have been a part of CLEAR for last 4 years. And today it's my great honor and privilege to present this session with you, share this session with you so that you can take away some understanding of the tax matter and you can utilize it at the time of declaration and income tax proof submission. Along with this journey, we will be having Rahul with me. Rahul is a qualified professional. He has a great amount of experience in income tax returns, income taxes, company law matters, and he's been helping with us in respect of tax filings and everything. And he will be there in the chat box. And if you have any question, he will be answering those. After the session is over, we will be having a live Q&A session as well, wherein we are going to answer all the questions that you might be having. Right. Uh, Before beginning, let's take a look at what are the subject matters we are going to talk about. Right. Firstly, we are going to take a look who should declare their income. Over here in this topic, we are going to discuss about some basics of tax return filings as well and taxation as well, and we are going to see what are the expenses and deduction that can be considered for income tax filing and what can be the proof of that. Furthermore, we are going to understand what will happen if you fail to submit the proof and if there are any repercussions and what are the remedies for it. And finally, we are going to talk about some tidbits about some things that you should keep in mind during the year so that your financial well-being is somewhat maintained. Excuse me. Now, kicking off this topic, this subject is who should declare their investment and why. Now, over here, I would like to start this slide with a notion or rather with the information that any person whose income is more than 2.5 lakh rupees in a year before claiming any deduction under chapter 6A, that is your LIC premium, medical insurance, etc., that person is liable to file their income tax return. Now, over here, a lot of people actually think if my income is not crossing 5 lakh rupees, I am not paying any income taxes, therefore, I am exempted from filing the income tax return. That is not the case. If your income is more than 2.5 lakh rupees before claiming any deduction, in that case, you are liable to file the income tax return. However, because your income is not crossing 5 lakh rupees, there is a rebate given to you. First, we are going to compute the taxes, calculate the taxes, and thereafter we are going to give you a rebate on the amount, right? By that virtue, you are not supposed to pay any taxes. But any person whose income is more than 2.5 L, that person is required to file their income tax return. Right. Now, while coming to the topic, who should declare their investment and why, one point comes up very clearly that if any person whose personal income, whose income is more than 5 lakh rupees, that person should declare the investment. Why? Because if my income is lesser than 5 lakh rupees, right, there is no benefit for me or rather no additional benefit for me if I declare my investment. Why? Because in any case, I will not be paying any income taxes, right? I will be computing the income, total income, and whatever the rebate is there, I will be getting. I will not be getting any benefit if I do not declare, if I declare any investment. However, if my income is more than 5 lakh rupees, then I have to firstly pay taxes on the amount which is more than 2.5 lakh rupees to 5 lakh rupees and any amount which is more than 5 lakh rupees, right? So my target would be my target for investment declaration and proof submission would be to reduce my tax outflow as much as possible, right? So my target would be to reduce my taxable income as much as possible, and if I declare my investment, then it has a chance of going very low, right? So in that case, any person whose salary income is more than 5 lakh rupees, that person should be declaring their investment. Second thing, any person opting for old tax regime. Now, as we all know, there are two regimes prevalent at this point of time: the new tax regime and the old tax regime. Under the new tax regime, lot many slabs are provided. However, the tax rate are quite smaller for each of these slabs. In the old tax regime, there are only three slabs, but tax rate are quite steep. The increment is quite steep. Main difference between these two is under the new tax regime, you are not eligible to claim any of the deduction except for a few. But under the old tax regime, all the tax saving deduction and expenses are allowed to be deducted. Therefore, if you have opted for old tax regime, you must submit all the investment proofs. Furthermore, it is again advisable, even if you are opting for new tax regime, it is advised that you keep a note and keep receipts of all the tax saving investment that you have made during the year. Why? Because even though you have declared to be taxed under new tax regime at the beginning of the year, at the time of filing the income tax return, you are allowed to switch. And if we do a comparative analysis at the time of filing the income tax return, we can see which regime is actually being beneficial for you, the new one or the old one. Therefore, it is very much recommended for you to keep all the investment proofs, documents, everything with you, even if you are going to be taxed under the new tax regime and that was selected at the beginning of the year. Now, what are the purpose? What are the things that need to be declared, right? Apart from investment, what you can declare is your additional income, right? To your employer, you can declare additional income. Again, this is a step many people choose to ignore, but it has a slight impact, or it may be having a huge impact depending on the marginal slab rate you are in. Right. So if most of the people has some sort of savings bank account or FDs or any of the things, right? So during the year, some sort of interest income comes from the FDs or savings bank account. And at the time of income tax return filing, you are required to disclose all these interest earned. Now, if the tax payable, the total tax payable on this additional income, we are not talking about salary, because in 99% of the cases, your employer will be taking care of it, right? So there is no point talking about it. But the additional incomes that you may be having, either this FD income or savings bank income, if it is beyond the threshold limit for savings bank income, it will be taxable in your case, right? And if the tax payable on these interest earnings, or you may be having some sort of dividend earnings as well, if you have some stocks or mutual funds, right? So if all the earnings lead to a tax payable, which is more than 10,000 rupees, then definitely advance tax liability would have been applicable for you. And since no tax has been paid on those incomes, the income tax department at the time of filing will charge some amount of interest from you as well. Therefore, and the interest rate is 1% per month under two different sections, right? In broader terms. So at the time of filing, if the tax payable is coming to, let's say, 50,000 or 60,000 rupees, you could easily end up paying around 2 to 3,000 rupees of interest, if not more than that, which you can easily avoid if you submit this earning detail to your employer. So not only you can or you should declare investment, you can submit the other source earning as well. which will enable your employer to deduct the taxes in a proper manner, and you would save a certain amount of interest as well. Now, having talked about what can be declared and why is there a need to declare the investment and investment proof, now let's take a look at the items which can be declared, right? First and foremost, we are going to talk about some tax saving expenses. Over here, we have categorized couple of tax saving expenses. First of which is a house rent allowance. Now, this is the most talked about and understood and applicable section under which tax saving happens. However, there are couple of misconceptions in respect of house rent allowance. First and foremost, people think that the actual amount of rent, whatever amount I am paying, that can be deducted as HR, which is not correct. So there is this income tax rule which actually says how the house rent allowance should be computed. The actual deductible house rent allowance should be computed, right? To get the actual amount, we need to figure out three amounts. First and foremost is 40% or 50% of your basic salary. Number two is your actual amount of HRA that you have received and which is a part of your salary. And number three is actual rent paid minus 10% of the basic. Now, we are going to have a discussion about it later in later slides, but for now, let's stop our understanding at this. Second point, another point over here is why is there 40% or 50% of basic mentioned? Now, 40% or 50%, that actually depends upon the city you are staying for your employment purposes, right? If you are staying in a metro city, in that case, 50% basic will be taken into consideration. Otherwise, 40% basic will be taken into consideration. Now, metro city, whenever I am saying this actually involves only four cities: Delhi, Mumbai, Kolkata, and Chennai. No other city, how big they are, not considered as metro city for the purpose of HRA. You may think that Bangalore or Pune or Gurgaon or Noida, all these cities are quite big, quite up and coming, and rent is quite high. Still, they are not considered as metro cities for the HRA benefit. Now, second point that we are going to talk about is leave travel allowance. Leave travel allowance again is a little less talked about section as compared to house rent allowance. Now, leave travel allowance is a great way to save some taxes while you are traveling, right? So if you are traveling, then the traveling expenses, certain traveling expenses can be claimed as deduction at the time of filing the income tax return, right? Now let's try to understand what are the uh, points that you should keep in mind while claiming or planning to claim leave travel allowance. Number one, leave travel allowance is allowed only twice in a block of 4 years, right? You can claim for 2 years, right? Once every year in a block of 4 years, right? So the recent block, the current block has started from 1st of January 2022. Second point is the traveling. The traveling should be within India. Third point is only train fare or air fare is allowed to be deducted. Now, there is also a mention of what sort of train fare or plane fare you should be considering, right? If you are traveling by train, AC 3 tier or AC first class fare would be considered. AC 2 tier or sleeper class or other sleeper class, it is not considered. If you are going through flight, then economy flight is considered, right? So if you are traveling by train, AC first class, 2 tier, 3 tier, these will be considered. Sleeper class or chair car, these two are not considered. If you are traveling by flight, in that case, only economy class flight is allowed. The not deductible expenses are your hotel expenses, your cab expenses. If you are traveling through cab from point A to point B, that is not allowed. The petrol, etc., etc., salary to driver, these are not allowed. Hotel staying, meal expenses, these are not considered, right? So, since the lockdown has lifted, people are planning to travel, and if you are traveling, you can certainly go ahead and claim this deduction. However, you must make sure that your salary has a LTA component embedded in it. If there is no LTA component in your salary, you, even though you have traveled, you cannot claim LTA. So be sure of that, whether your salary has a LTA component or not. Or some of the organization, they allow you to rebalance your salary structure. In that case, if you are allowed to do so, then certainly you can go ahead and allocate some money in LTA as well, so that you can take the tax benefit. Again, couple of things you should be keeping in mind. Number one, flight ticket and boarding pass. These two items can be taken as investment proofs. If you are traveling by train, then train ticket, obviously. Also, if in any previous year, or rather in the previous block, you have not availed the LTA benefit, then in the second block, that is the block that we are in right now, you can claim LTA for 3 times, right? So if you have not claimed any LTA, right? If you have not claimed any LTA in the previous block, then in the next block you can claim thrice, but one must be taken in the first year itself. Excuse me. Now, having understood the house rent allowance and leave travel allowance, let's go on to tax saving. What are the tax saving expenses? Now, the second tax, or rather the third tax saving expenses that comes into our mind is home loan interest. Now, many of us has taken a home loan for purchase of a house or construction of a house, right? Now, whatever amount of interest that you are paying, that can be deductible up to certain limit. Again, there are certain conditions. If the house property that you have purchasing, the flat, the apartment, the actual house, whatever it may be, that needs to be self-occupied, right? You can go ahead and claim it. If this house property is self-occupied, then the amount of interest that can be claimed as loss on house property is 2 lakh rupees. If this house property is let out, that means you are owner of the house and you have let out this house property, the flat, to anyone else, then there is no limit of interest payment. In case of self-occupied house property, it is 2 lakhs. Second point is, the interest would be allowed as deduction from the year the house is completed, the flat is completed. Now, there are many instances wherein you have purchased a flat uh, when it is under construction, right? After 2 years or 3 years, you will get the possession letter. The house will be completed after 2-3 years. But from the year of its completion, you will be getting the deduction of the interest. However, till the construction is going on, you most definitely will be paying some amount of interest. What will happen to it? Now, again, that's a very valid question. If you have purchased a under construction house property, you cannot claim the interest most definitely. You cannot claim the interest most definitely, but you will be given this opportunity to accumulate that interest. That means you can postpone the claim of interest when the house is completed, right? For the interest that you have already paid. right? So let's try to understand how this happens. Let's say on 1st of April 2020, you have made the purchase, right? Now the house was completed in 31st of March 2022, right? So for 2 years you have paid interest. Each of the year, let's assume you have paid 1 lakh rupees of interest, right? So for 2 years you have paid in total of 2 lakh rupees. Now this 2 lakh rupees will be given to you in 5 equal installment in 5 years, 5 consecutive years. So that will give us 40,000 rupees of interest of claim, pre-construction interest claim, after the house is handed over to you, after the house is completed and handed over to you. Therefore, on the third year itself, you will be able to claim the amount of interest that you have paid for that year, plus the accumulated interest, the proportionate accumulated interest. Let's assume in the financial year beginning from 1st of April 2022, in that financial year, you have received the possession, the house was completed. In that year, let's assume you have paid an interest of 1,50,000 rupees, right? So you will be able to claim this 1,50,000 rupees plus 40,000 rupees that was proportionate interest for the previous years, previous 2 years. However, there is a catch. The total interest claim cannot be more than 2 lakh rupees. So, if in that scenario your total interest for the third year is coming to, let's say, 1,70,000 rupees, in that case your total interest claim would be 2,10,000 rupees, right? Now, out of this 2,10,000 rupees, you will be able to claim only 2 lakh rupees, since this is a self-occupied house property. There are a couple of questions which generally arises while talking about home loans, right? For example, what is self-occupied house property? And can I claim LTA and can I claim HRA and interest on home loan together or not? Firstly, we are going to discuss what is a self-occupied house property. And if we really pay attention to this, the second question will be pretty much self-explanatory. Self-occupied house property means a house property that I am residing in or my parents are residing in, right? So if I am not present in that house property, but my dependent parents are present in that house property, in that case, that house property too will be considered as self-occupied house property. Therefore, let's try to link this scenario with the HRA, right? Now, the HRA actually says, the law regarding HRA says that if you are staying in a rented premises for your employment purpose, HRA, house rent allowance, will be given to you. Second point is, if you are staying in a self-occupied house property, then if you have taken an interest, a loan, and paying interest on that, that will be deductible from your total income to certain amount. And third point is, your parents, if they are staying in this house property, that can be considered as self-occupied house property. Now, if we try to link these 3 points together, the answer to our question becomes very much self-explanatory. That is, we can go ahead and claim HRA and interest on home loan together. There is no bar. If we are staying in a different city than our native place, we can definitely go ahead and claim HRA plus home loan interest together. There is no problem, no bar whatsoever. Now, till now we have talked about the interest claim under section 24B. There is another section though, that under which you can take the interest on house property. However, this is on top of the section 24B that we have talked about. This section in question is section 80EEA. Now, section 80EEA gives you additional deduction of 1.5 lakh rupees if you are meeting certain conditions. Like, number one, the loan should be taken from a bank most definitely. Secondly, the loan should be sanctioned between 1st of April 2019 to 31st of March 2023. Uh, Thirdly, the stamp duty value of that property should not be more than 45 lakh rupees. And finally, the house property that you are intending to purchase must be your first house property. At the time of purchase of this property, there should not be any house property registered in your name. It can be a purchased property, it can be an inherited property, whatever it may be. There must not be any other property registered in your name. If you fulfill these conditions, then you can claim 2 lakh rupees under section 24B as well as section 80 EEA 1.5 lakh rupees. Again, another popular question is that there are two borrowers of a property, right? Say, for example, a pair of husband and wife is taking a home loan and purchasing a flat, right? In that case, what will happen? Now, if the house property, the flat, is under joint ownership, that is, the husband and the wife both are owner of that property, and the loan has been taken by both. If these conditions are satisfied, in that case, both of them will be able to claim the interest on house property as well as principal on that house property loan. However, the interest and principal, these two will be split evenly between husband and wife, right? There is no 60-40 or 70-30 percentage whatsoever. It will be split evenly between two persons. Moving on, what are the other tax saving instruments under ATC? Now, under ATC, one of the most important, or rather most uh, this is the default tax saving deduction, that is employer provident fund. Every month your employer deducts certain amount of salary, certain amount from your salary, for which there is no need to submit any proofs because your employer is doing it on your behalf. However, there are a couple of other provident funds as well. One is public provident fund, another is volunteer provident fund, voluntary provident fund. Sorry. Now, under PPF, the maximum you can invest is 1.5 lakh rupees. PPF, there is no limit as such. However, if your investment is crossing certain limit, that is 2.5 lakh rupees, then you have to pay taxes on the interest that is earned if your investment is more than 2.5 lakh rupees, right? So if you are investing in VPF 3 worth rupees 3 lakh, up to 2,50,000 rupees, there will not be any taxability on the interest that you have earned. Beyond that, on 50,000 rupees, there will, if you have earned interest on that 50,000 rupees, there will be tax implications. Then, children's tuition fee. Again, if your children is admitted to a school or university or colleges, whatever amount you are paying as tuition fees, that can be deductible under ATC. Please make a note that developmental fees or donations, these items are not allowed to be deducted. Only admission fees and tuition fees, the actual tuition fees, these two items are deductible. Thirdly, life insurance premium. If you have taken an insurance policy from a registered insurer, which is registered under insurance regulators of India, then any amount that you are paying to keep that policy in force will be allowed as deduction. Thirdly, principal on home loan, right? We have talked about the interest component of that home loan, how it can be deducted. The principal component is also deductible, and the deduction comes in the form of under ATC, form of ATC, right? Any amount you are paying which is a part of EMI, which goes towards the principal repayment, that can be claimed as principal, that can be claimed under ATC. Furthermore, Not only principal on the home loan, if you have purchased a house, then stamp duty that you have paid or registration fees that you have paid, that can also be claimed under ATC. 80CCC, that is your pension plan. Any plan you have taken to enforce a pension, right, at the time of your retirement, that amount can be taken as deduction under ATC. Further ahead, national pension scheme. Now, these are some of the most underrated pension scheme or tax saving instrument that I have seen. Employee contribution, that is your own contribution towards national pension scheme. If you are, excuse me, if you are investing in NPS, firstly, the first deduction will be go towards section 80C, and that is under that is the limit, that has the limit of 1,50,000 rupees. However, there are two special provisions for national pension scheme. Now, these will be our main focus of discussion. Firstly, we are going to talk about 80CCD2, and second, we are going to talk about 80CCD1B. Now, let's talk about 80CCD1B because this can be invested from on your own, right? Now, if you are investing on your own in NPS, then by the virtue you are investing in NPS, you get an additional 50,000 rupees of deduction. This deduction is exclusively set aside for NPS, right? Let's try to understand this deduction, what I have been talking about, right? So let's assume you have fulfilled your ATC limit, right? You have a home loan principal repayment of 1 lakh rupees. You have provident fund worth 20,000 rupees. You have ELSS worth 30,000 rupees, right? So your ATC limit is already eaten up, right? However, in this scenario, if you invest, let's say another 30,000 rupees or 40,000 rupees in NPS on your own voluntarily, in that case, you will get that amount as deduction, not under 80C, but under 80CCD1B. We are going to see the numbers, how this plays out and how it can save you the taxes in an upcoming slide. Furthermore, talking about NPS, there is another section in NPS that is 80CCD2. Now, 80CCD2, excuse me, under 80CCD2, you can set aside a certain amount of your salary to which can go towards your NPS contribution, which is made by your employer. Now, the maximum amount that can go towards NPS through your employer is 10% of your basic salary, right? However, this amount is limited, the 10%, even though there is a percentage attached to it, maximum amount that can be contributed without any tax implication is 7.5 lakh rupees, right? So if 10% of your basic salary is lesser than 7.5 lakh rupees, you can expect some amount of tax deductions. Now, we have talked about the tax saving expenses and tax saving deductions. Now, these items are a part of a system which is old tax regime. Now, there is another tax regime, that is the new tax regime, under which there are multiple slabs. However, the rates of taxes are, the increase in rate of taxes is much smaller as compared to the old tax regime. However, it may give a rise to a question whether this is beneficial for us or not. Based on the data that we have seen, that very less number of people are actually going for new tax regime. In clear tax, we actually have a system wherein we compare the regimes for you and choose whichever regime is much more beneficial for you, right? So most of the time the new tax regime does not make any sense to people. Why? Because from our childhood we have seen our parents saving their money, right? Either in tax saving FDs or any other sources, right? New generation, they seeing their parents, looking their parents, they also they also get into the habit of tax saving, right? In that case uh, whatever happens is uh, they start investing the money, even if they are not investing the money in the instrument that is preferred by their parents. Therefore, after 2 3 years of service, they have a quite a big number of tax saving instruments at their disposal, right? By that logic, the new tax regime becomes less attractive for those people. Now, over here, we have done a comparison. We have taken a salary structure, which is 5 lakh rupees of basic, 2 lakh rupees of HRA, and any other allowance, which is coming to 3 lakh rupees. Total, the salary is coming to 10 lakh rupees, right? That person is staying in Bangalore, we have assumed it, and the rental amount is 20,000 rupees a month, which is giving me 2,40,000 rupees, right? Now, try to understand what will be the tax position under both the tax regimes, right? In the new tax regime, there is no deduction available. There is no standard deduction, tax on employment, HRA, etc., etc. Therefore, whatever amount of gross salary I am getting, that will become my net salary. However, under the old tax regime, gross salary is coming to 10 lakh rupees. From there, based on the numbers that we have done, based on the discussions that we have done in the HRA slide, my computed HRA is coming to 1,90,000 rupees. How? So staying in Bangalore, 40% of the basic will be considered. Actual amount of HRA will be considered, and rent paid minus 10% of the basic, which will be considered, right? By this, the least number that is coming up is 1,90,000, and that will be considered as HRA. Also, we are going to reduce the standard deduction and professional taxes, tax on employment, together which the income is coming to 7,57,000 rupees. Right? From there, we are assuming that that person has utilized their ATC limit properly along with medical insurance. Again, under the new tax regime, no deduction of such kind is allowed. However, the old tax regime, all these deductions are allowed, which will give us income of taxable income of 6,19,000 rupees. Now, let's try to comprehend how the tax computation happens. Up to 2,50,000 rupees, there is no taxes as the tax rate is zero. From 2,50,000 rupees to 5 lakh rupees, again, tax rate is 5% under both the regimes, so the tax is coming to 12,500 rupees. Now, let's move on to the new tax regime. Since there are no deduction, my income is still at 10 lakh rupees level. From 5 lakh rupees to 7 lakh 50,000 rupees, that rate of tax is 10%, which will give me 25,000 rupees because my income is increasing by 2,50,000 rupees. 10% of that is 25,000 rupees. And finally, from 7 lakh to 10 lakh, 7 lakh 50,000 to 10 lakh, again, an increase of 25,000, but the tax rate increases to 15%, which actually gives me 37,500 rupees as taxes. All in all, 75,000 rupees of taxes I need to pay under the new tax regime. Coming to old tax regime, up to 5 lakh rupees, the rate is 5%. So increase is to 2 lakh 50,000 rupees, and 5% is the rate. So it will give me 12,500 rupees. Finally, we need to see what is the excess amount that I am left with beyond 5 lakhs, which will be coming to 1,19,000 rupees. Now, the rate of tax over here is 20%, right? So, from 5 lakhs to 10 lakh rupees under the old tax regime, that rate of tax is 20%. which actually gives me 23,800 rupees of taxes, totaling to 36,300 rupees of taxes under the old tax regime. Even if we add the cess, the health and education cess, that will give us 37,750 rupees of taxes as compared to 76,000 rupees, 78,000 rupees under the new tax regime. So there you go, a straight up 40,000 rupees of tax saving under the old tax regime. Now, we have talked about tax saving using the NPS, right? This slide actually depicts that. So again, if your contribution towards NPS for the year is coming to 65,000 rupees, the maximum amount that you can claim is 50,000 rupees. Assuming you fall in the highest marginal slab rate, your tax savings will be 15,000 rupees plus 4% of health and education cess on that 15,000 rupees. That will give you a tax saving of 15,600 rupees. Now, what are the other areas which can be explored beyond ATC? First and foremost, health insurance premium. Now, this pandemic has shown us that getting a health insurance policy is a very good idea, right? So, maximum amount that you can claim for yourself is 25,000 rupees. Yourself means you, your spouse, your dependent kids, and you can claim additional 25,000 rupees for your parents. However, if parents are senior citizen, then this 25,000 rupees limit gets extended to 50,000 rupees, right? And finally, what other tax saving deductions are there? You can claim a deduction under Section 80DD, which actually talks about if any of the dependent family member is differently abled. Now, if that person is disability level of that person is more than 40% but lesser than 80%, in that case 75,000 rupees to medical expenses, etc., etc. If you are maintaining, that is a flat deduction. And if the person is having severe disability, in that case 1,25,000 rupees will be the deduction limit. ATU, if the assessee himself or herself is differently abled, then same level and same amount will be applicable for that person, although under a different section, that is Section 80U. What other section for these medical treatments? That is 80DDB. If one person is suffering from some serious diseases such as cancer or AIDS or motor neuron diseases, in that case, Section 80 DDB, that person can get a deduction. Right? All right. Now, as of now, we have understood what are the expenses or deduction that can be taken. Right? Now, let's try to understand when to submit this and what happens if you do not submit this and what can be the remedy for it. First and foremost, you are supposed to declare your investment planning at the very beginning of the year, along with your selection of the regimes, whether you want to be taxed under the new tax regime or the old tax regime. Along with that, you are going to give a summary of investment that you are going to make during the year. You can say that I will be staying in a rented place, wherein I will be paying, let's say, 30,000 rupees per month as rent. You can say that I will be making a ELSS investment during the year, for which I will be making an investment of 4,000 rupees per month under SIP. So 48,000 rupees. This way. However, even if you declare, what happens is, based on your declaration, your employer actually computes the taxes and deducts the taxes. Now, over here, at the time of computing the taxes, the employer actually acts as agents of the government, right? They are the person that needs to ensure tax is properly computed and submitted in the hands of government under each of your PAN, right? So employer acts as an agent, the tax computation part for salaried people, tax computation, tax deduction, all this part. Now it is their duty to verify if you have actually made the investment as declared by you at the beginning of the year, right? Therefore, what they do is they open up a window within which you must declare all the income that you or other investment that you have made, right? Now, let's say at the beginning of the year, you said that I will be making a ELSS investment. I will be making a ELSS investment, a bulk 50,000 rupees, right? But at the time of the window, at the time of submitting the proof, you have not made that investment. So you don't really have any proof. So what will happen? Your employer will completely ignore that 50,000 rupees declaration. Your income will be increased by 50,000 rupees as compared to previous months. And what they will do is they will withhold the amount of tax that happens on that 50,000 rupees, and that too will happen after the declaration window is closed. So for example, if the declaration window is from 1st of January to 31st of January, they will completely ignore that you have made a declaration in the month of April about 50,000 rupees of ELSS investment, right? They will compute the taxes, assuming again you are falling in 30% slab rate, right? So they will completely ignore it because you have not made the investment, you have not submitted the proof. The tax of that on that 50,000 will be coming to 15,000 rupees. Now these 15,000 rupees will be deducted in the last 3 months salary, right? With January, February, and March, you can see an additional tax outflow of about 5,000 rupees per month. Same situation may arise for any other investment as well. So we have talked about one example. This can happen, this can translate into other declarations as well. So if the window is open, the declaration window is open, I strongly suggest to take a small amount of time. It will take hardly 30-40 minutes to gather all the documents and upload it so that you can save yourself a heartache, right? Uh, every month we are supposed to get XYZ amount of money, and suddenly, if we are getting 5,000 rupees lesser than that, that certainly gives us a heartache. Our financial planning, everything, planning for a vacation, that goes for a toss, right? So just keep it in mind, if you spend 30-40 minutes at the time of submitting the proofs, that can save you a lot of heartache. Now we have talked about why the proof submission is important and what will happen if you do not submit the proof. But what is the remedy if you have actually invested money? Now, and in that case, what can happen is, if you have missed the submission window, right? There is nothing you can do. However, you actually have made this investment. What will happen at the time? Your employer at that time will deduct higher amount of taxes. But at the time of filing your income tax return, you can show that yes, I have indeed made this investment, and yes, I want to claim it. I want to claim it, and you can actually claim those investment at the time of filing your income tax return, even though these declarations are not part of your form 16, provided your ATC limit is still empty. Your ATD limit is still has some room. ATC has some room in there, ATD has some room in there. In that case, most definitely you will be able to claim. However, for 2-3 months, there will be a higher amount of tax outflow. Now, we're almost at the end of our session. Here, I would like to talk about a couple of things that we have seen, right? These are coming from our personal experience. Sometimes it may so happen you decide to switch your career. Sometimes it may so happen you get a better offer and switch to your present employer. However, in the year of such switches, couple of things that really comes into foray, that is, since the newer employer do not have any information, the data of your previous employer's earning, they assume that this is your first employment and they deduct taxes. They compute the taxes and deduct the taxes accordingly, right? So what they do is they ignore the fact that your previous employer has considered a certain amount of ATC deduction. Your present employer ignores that standard deduction of 50,000 rupees has been already a part of tax computation by your previous employer. They also ignores the fact that in your tax computation, basic exemption limit of 2,50,000 rupees has already been factored in. They give you these deductions, these exemptions, this benefit all over again. And by this logic, their tax computation goes way off, right? So what happens in this case? The worst thing that actually happens is you need to pay a certain amount of taxes. It can be a huge amount depending on the salary level that you are having. It can lead to a huge amount of tax payable at the time of filing your income tax return. The That's the bad thing that is going to happen. But there is a worst thing that can happen, or that is happening. That is, you need to pay interest on the tax that you are supposed to be paying, right? So there is a double blow in your case if you are not submitting earning and tax deduction from your previous employer to your current employer. You need to pay number one taxes, number two, you need to pay a certain amount of interest as well, right? So while you are switching the jobs, please make sure you submit all this information to your present employer that I have earned XYZ amount of money from my previous employment. I have earned, or they have deducted XYZ amount of taxes from previous employment, so that they can consider proper amount of income and proper amount of taxes and start deducting taxes on a proper level. Now, I would like to really thank all of you for joining with us. This is the end of our session, and we will be going to the question answer session. Right. So we are at the end of our session. Thanks for joining in.